Hi there. In this video, we explain how the 60% tax trap works and what UK earners should consider to manage their tax position.
Imagine you run a successful SME. You close the year strong, taking a £10,000 bonus. On paper, this looks like a clear financial victory, but UK tax law dictates a different outcome. Higher rate tax strips away £4,000. A taper rule clawbacks £2,000. National insurance extracts £200. And for families, crossing this threshold triggers an immediate total loss of state-funded childcare support. You successfully increased your top-line revenue, yet the compound effect of these deductions results in a negative net wealth position for your household. Most taxpayers assume the 45% additional rate, applied to earnings over £125,140, is the absolute ceiling of the UK tax system. That assumption is mathematically incorrect. The most punishing zone in the UK tax code sits hidden in the middle tier, exposing high earners to a staggering 62% effective deduction rate. ProTax Accountant is a leading UK consultancy specializing in exposing these structural anomalies. We engineer compliant pathways around these hidden fiscal barriers. Escaping this trap isn't achieved by simply driving up top-line revenue. It requires a complete structural overhaul of how you extract corporate profit. To understand the trap, we start with the baseline. For the 2026-27 tax year, the standard personal allowance, the income you earn entirely tax-free, is frozen at £12,570. This chart plots the statutory UK income tax brackets. Notice the £100,000 threshold. For every £2 earned above this line, HMRC withdraws £1 of your tax-free personal allowance. When we map that withdrawal rule onto your income, we expose the true effective marginal rate. Let us track a single £100 increment earned inside this zone. First, £40 is immediately lost to the standard 40% higher rate tax. Second, you lose £50 of your tax-free allowance. That £50 is now exposed to the 40% tax rate, creating a tertiary penalty of £20. Finally, add the 2% employee national insurance liability. £40 plus £20 plus £2. That is a 62% effective deduction on every pound earned. If you are a Scottish resident subject to devolved tax powers, the advanced rate calculation pushes this penalty even higher, to an effective 69.5%. The 60% trap is not a legislated tax band. It is a mathematical artifact constructed by the tapering rule, operating as a distinct penalty on middle market success. The personal allowance taper is gradual. The loss of family support entitlements is not. At exactly £100,000 of adjusted net income, you hit a binary limit. You instantly lose tax-free childcare and 30 hours of funded childcare. Compare a founder drawing £105,000 against one capping at £99,900. Factoring in lost childcare, the higher earner finishes with less disposable capital. Accepting a salary increase across this boundary without mitigation is mathematically irrational. HMRC determines your placement in this trap using a strict metric called adjusted net income. It calculates total taxable revenue before personal allowances are applied. For SME owners, corporate dividends count directly toward adjusted net income, filling the space beneath the £100,000 threshold. With 2026 dividend taxes hiked to 35.75%, breaching this limit triggers a severe dual penalty, the elevated tax itself, plus the loss of your personal allowance. The mitigation strategy requires legally suppressing your adjusted net income. Statutory relief mechanisms like salary sacrifice and gift aid function as relief valves. By diverting capital through these channels, you reduce your ANI and effectively buy back your lost personal allowance. Accurate execution requires meticulous tracking. Every taxable stream, including benefits in kind like company vehicles or medical insurance, must be accounted for before the April 5th deadline. For SME directors, the most powerful extraction tool is the employer pension contribution. Routing profits directly from the company into a pension reduces corporation tax, bypasses the 15% employer national insurance liability entirely, and keeps the capital completely out of your personal ANI. By utilizing HMRC-sanctioned vehicles to bypass the 60%, the personal allowance is preserved in full. Childcare remains active, and corporate value transfers efficiently to personal wealth. With income tax thresholds firmly frozen by the Treasury until 2031, Passive acceptance of a standard PAY structure is financial negligence. The calculations explored here are educational. Because the tax code interacts differently with every unique corporate structure, independent professional validation is required. Navigating the 2026 fiscal landscape demands bespoke corporate and personal tax engineering. That requires the technical precision of specialists like ProTax Accountant. Reach out to ProTax Accountant today to audit your extraction strategy and implement these adjustments before the current tax year closes. Do not allow hard-earned corporate revenue to fall into a predictable statutory trap. Proactive structuring is your ultimate defense.